Good morning. It's good to see so many of you joining to hear our analysis from our experts on a budget that had more build-up and drama than any other I can remember. My name's Tim Stovold. I'm one of the tax partners at Moore Kingston Smith. I'm sure most of you are familiar with who we are, as I can see lots of regular names on the attendee list. However, for those of you who don't know us so well, Moore Kingston Smith is a top 10 audit, tax and advisory firm working with businesses across all industries, non-profit organisations, as well as private clients. We're also part of More Global, an international network with presence in over 100 countries. So yesterday we had the second budget from Rachel Reeves, which caused upset a year ago with changes to IHT rules for farmers and the abolition of the winter fuel allowance. This should have been a return to stability. However, the weeks leading up to the budget included a new rumour on tax changes nearly every day, which created an uncertain environment, making it very difficult for individuals and businesses to plan. Now the uncertainty is over, normality will soon return, we hope. And we hope also to see some growth in the economy that the Chancellor definitely needs to balance the books. As ever, the devil was in the details, so I'm delighted to be joined by my fellow tax colleagues, Nick Blundell, Claire Roberts and David Hartles. Nick, some of you will know, is a specialist in all things relating to corporate and business taxes, and Claire and David are two of our private client experts. My job today will be to chair today's session and also muck in to cover employment tax related issues. I'll also be keeping an eye on your questions as the panel run through the detail and picking out the most difficult ones to put to them. Just as a plea, please put your questions, which I'm sure you'll have many, into the Q&A section in Zoom, not into the comments, and I'll weave those into the presentation. Those that we don't answer, we'll try and follow up on after the presentation, so we make sure you get everything you want from this session. So to get started, I'm going to continue on. I'm just going to remind ourselves of the context in which this budget was given. So I think as we click through, you can see us all. So there's our contact details. The slides will be circulated afterwards, so you've got our details should you wish to follow anything up. So I'm going to go through the fiscal and political context in which the budget was given, and then the experts are going to go through the areas of personal tax, employment tax, corporate and business, and indirect taxes. And there was something in all those areas. So the context, I mean, all of you know this, so this is really just a reminder. The Chancellor was very much boxed in with the manifesto commitment. So we had a commitment not to increase basic, higher or additional rates of income tax, not to increase national insurance or VAT, to continue at the 25% corporation tax rate, and a general commitment not to increase taxes on working people. Now, the working people commitment has been seen through, so the tax changes, which we'll hear about later, are largely impacting savers and investors, but broadly what's been done is more or less manifesto compliant, which has kept the backbenchers happy. Keir Starmer, when he was challenged in in Prime Minister's questions on whether he would stick to the manifesto, he didn't really answer the question. So that just fueled the rumours that we were going to be facing some manifesto breaking income tax increases. We'll see how Rachel Reeves managed to stay within the manifesto as we hear more. In the run up to 26th November yesterday, it seems like an age ago given the build up, we had the OBR continually downgrading the UK's productivity performance, which again raised the possibility of much larger increases than we were expecting. We had a flip-flopping budget deficit estimate of something between 20 and 30 billion. Again, the only way it felt that could be solved was with increases to income taxes. And we had a lot of speculation around income tax increases, the introduction of an exit tax, pension tax reform, changes to property taxation. As I say, almost every day there was a new rumour. What we had in the run-up to the actual event, we had a confirmation on the two-child benefit cap being scrapped from 2026, a measure that's costing around £3 billion. We had the milkshake tax, which was an early announcement, which has been seen through into the budget. And then the most fun, particularly for the tax profession, was a leaking of almost the entire detail from the budget in about the hour or so before the Chancellor stood up. So we had some furious Googling as the OBR took the report back down to see who'd managed to download it, and then starting to go through the detail way ahead of when we would normally get it. So it's been something of a roller coaster, but we shall start with Claire walking us through the personal tax changes.
Thanks, Tim. So personal tax, this was where we were expecting, I think, the most announcements, and we did see several measures, but perhaps not as many or as severe as perhaps people had feared. So the big measure, the big change, which was widely expected, was the extension of the freeze to income tax and national insurance thresholds, and that's been extended for a further 3 years to 2031. at which point these personal tax thresholds will have remained in place for 10 years. So really quite a long time if you consider wage inflation in that period. So the income tax and national insurance thresholds now you can see there are at 12,570 before you pay any tax and national insurance. The higher rate threshold is now will stay at 50,270, and the additional rate threshold is at 125,140 pounds. So whilst it might seem like quite a benign measure, so unlike an income tax rise, you don't immediately, that move isn't immediately obvious to the taxpayer. It is significant. It's going to raise a lot of money for the government, estimated to be 12 billion by 2031, as that fiscal drag drags more and more people into paying higher rate and additional rate tax. The OBR estimates that will now mean that by 2030, 1 in 4 taxpayers will be higher rate taxpayers, and that from the period from 2023 up until 2031, that will bring in an extra 4.8 million taxpayers into the higher rate. So, depending on your view, whilst the manifesto pledge was arguably maintained by not increasing the tax for working people, in some ways, this is precisely what is happening with this threshold freeze. Just to mention on the state pension, so as many of you I'm sure know, the state pension is liable to income tax, but in most cases, if your sole source of income is that state pension, you don't pay tax on it because it falls within your personal allowance. From 27-28, with the extension to the triple lock, that will in fact cause people with the state pension to have a tax liability on that income. So with that in mind, the government are looking to ease that administrative burden for pensioners, so that they don't have to pay those small amounts of tax on their state pension through the simple assessment system. There'll be more detail out on how they plan to do that from next year. So, unless you weren't following the news in the lead up to the budget, there was a lot of hokey-cokey on whether or not income tax rates would be increased. But what we now know is that there is going to be a 2% income tax rate increase for property, savings, and dividend income. And the aim of that is to reduce the disparities for people with employment income who obviously pay national insurance on that income as well. So for dividend income, the tax rate is going to increase by 2%. So the ordinary rate will increase from 8.75 to 10.75, and the upper rate from 33.75 to 35.75, both from April next year. Quite curiously, the additional rate will remain unchanged at 39.35%. So if you are already an additional rate taxpayer because salary that uses up that band, then you're not going to be affected by this change if you have dividend income. So there is an opportunity here, if to the extent that you can accelerate dividend income, to do so before April 2026 if you expect your taxable income to be below the additional rate threshold of 125,140. Also just worth mentioning, the dividend allowance of £500, it will be unchanged, so everyone still is entitled to that. Similarly, we're seeing a 2% increase in savings income rates, so that will rise from 20 to 22% for basic rate taxpayers, 40 to 42% for higher rate taxpayers, and to 47% for additional rate taxpayers. Again, the personal savings allowance remains unchanged. So to the extent that you have interest within the £1,000 limit if you're a basic rate taxpayer, and 500 if you're a higher rate taxpayer, then that will remain tax-free. We're also going to see separate tax rates being introduced for property income, and they'll also be established from April 2027, and they will mirror the rates I've just mentioned, so 22, 42, 47%. I think it's also just worth mentioning and bearing in mind that landlords, already at a disadvantage in how they are taxed on their rental profits. because relief for mortgage interest, finance costs is given at the basic rate of tax. So that's currently 20% and will increase to 22% from April 2027. So it does mean that for landlords owning property with mortgages, that the marginal rate of tax can actually far exceed the headline rates mentioned there. So arguably another blow to landlords in what is already quite a high tax regime and highly regulated sector. So what we now may see is landlords deciding to sell up or a push towards incorporation. And I think if we look at these measures in the round in terms of the overall increase in taxes on investment income, we may now see a greater shift towards incorporation more generally through investing through companies, personal or family investment companies, to benefit from that lower rate of corporation tax. And also the dividends received by companies are generally exempt from corporation tax. So that may be something that we see shift towards as a result of these changes. So some other smaller income tax measures that perhaps haven't hit the headlines, but I think are worth mentioning. So the current position is that if you are required to work from home by your employer, then you can claim tax relief on certain additional costs that you incur. So heating, electricity, broadband, if they're not reimbursed by your employer. So you can either claim on an actual basis based on your receipts and your actual usage, or there's a flat rate deduction of £6 per week, which you're not required to show any receipts. And this was claimed by millions during the pandemic and has continued to be claimed by a lot of employees post-COVID that are required to work from home. Now, there has been a lot of non-compliance in this area, according to HMRC, and over half of claims were deemed ineligible. So they have decided to scrap this altogether from April 2026. So employees can no longer claim tax relief for home working expenses, but to the extent that employers reimburse home working expenses, that is still allowable within the existing rules. So if you were claiming that flat rate deduction, that will cost you an extra £62 if you're a basic rate taxpayer and £124 if you're a high rate taxpayer from next year. Making tax digital for income tax self-assessment. Many of you have probably heard of this. It was first announced over 10 years ago. We still haven't seen its introduction, but it is being introduced from April next year, and it's the initiative aimed at modernising the tax system for self-employed individuals and for landlords, and it will require those individuals to maintain digital records and submit quarterly returns to HMRC using software. Many people aren't ready for this, quite frankly. So thankfully, we have seen an announcement that there'll be no penalties for those coming into MTD from next year. So there will be a soft landing there while people get to grips with the systems. And there was also an announcement that there will be a small group of taxpayers that will be exempt from making tax digital, and the start date for a certain group of taxpayers will also be deferred to April 2027. We don't yet know the details of that, so watch this space. But I think for the majority of taxpayers, if you are expected to be in from April next year, you can assume that you will continue to be so. And finally, we saw an announcement on that there will be now, from April 2029, the government are looking at more timely payments for self-assessment taxpayers with pay-as-you-earn income. And that will be a move to pay more of your self-assessment liabilities in year, so probably monthly, with an aim of collecting more tax in real time. And again, we'll have more details on that when the government consult on it. Capital gains tax. So this is obviously an area that's rumoured every year in terms of possible increase in tax rates. There was a big rumour this year around possible restrictions to private residence relief on high value property, but no such changes were announced, thankfully. So we have the current rates of CGT remaining in place, so that's 18% for gains falling within the basic rate band and 24% thereafter. There was a change announced in relation to capital gains tax relief on a disposal to employee ownership trusts, but that will be covered by Tim in the next few slides. So the Chancellor did stop short of introducing a full blown wealth tax, but what we did see is a mansion tax, or what is we now know is the high value council tax surcharge, and that will apply to residential properties in England valued at over 2 million. So the surcharge will apply as follows. There'll be 4 price bands, which you can see there. So there'll be a charge of £2,500 for properties valued at 2 to 2.5 million, rising, as you can see, to £7,500 for properties over 5 million. It will be updated with inflation each year, the surcharge, will be payable from April 2028 based on 2026 valuations, with those revaluations being conducted every 5 years. In the short term leading up to its introduction, it is actually expected to cost the Treasury 335 million, because the expectation is that it will distort the property market as transactions bunch around the thresholds just below. So it is expected to cost that in the loss of stamp duty land tax and capital gains tax. But from April 2028, when it will be introduced, it's expected to raise 430 million annually. So not a huge amount really in the grand scheme of things when you think about these measures, and it does beg the question, bearing in mind the distortion it's going to have on the property market. Is it really worth a huge amount of work that will be involved in implementing this and policing it?
There's a question came in, which is probably the point you're about to mention. Is it going to local government or central government?
Central government.
It starts with local government. The intention is it moves to central government later, but I think what the government are expecting is that there'll be less money provided to local authorities from the centre. This is very much a sort of invest in the community spin being put on this new tax. But as Claire says, it really isn't going to raise very much in the grand schemes of budgetary measure.
Yeah. So the surcharge is expected to cover ownership structures, including companies, funds, partnerships, but the government will be consulting early next year on the rules relating to how that will work. They'll also be consulting on the possible reliefs and exemptions from the charge for those people that are required to live in properties as a result of their jobs. And there's also likely to be a deferral system for those people that are asset rich, cash poor, that may struggle to pay the surcharge. And it's estimated or expected rather that the surcharge will then apply when the property is sold or on death. But what we don't yet know is whether that will incur any interest for late payment. So all this will be consulted on next year when we can, when we'll know more details.
Just a couple one observation, Clara. Will this influence actions like converting larger properties into flats? Quite probably. I mean, the £2,500 a year at the bottom end is not a huge sum, but it will certainly focus people's minds. And then another question: do we expect lower value property could be included in subsequent years? Well, the revaluation is every 5 years, so if you're not more than 2 million in 2026. The next time you're going to be considered to go into the charge will be 2031. So yeah, if you're not in once, you've got 5 years grace before you could be considered to be coming in again.
I guess it does beg the question, though, whether once this is up and running, whether the government would take the decision to look at the council tax system more generally in terms of reform, given that the valuations at the moment are based on 1991 values. Okay, moving on, and I'll hand over to David.
Thanks, Claire. Good morning. Inheritance tax, another one that there was plenty of rumours before the budget that the government might change even more, but in the end, not a lot happened. There was no cancellation of the residence nil rate band, no limits on lifetime gifting, no changes to the 7-year rules for potentially exempt transfers. So actually, they left things pretty much alone. But as with other tax rates, they have frozen the nil rate bands until 2031. So as you can see there, it's still 325,000 for the basic nil rate band. The residence nil rate band stays at 175,000. And the new £1 million nil rate ban that they're bringing in next April to catch agricultural property and business property will also be fixed at the £1 million. One thing they did change on the agricultural and business property was that £1 million allowance. Now, obviously, from April next year, we have the new rates of IHT on agricultural and business property relief. Instead of 100% relief, we're only getting 50% relief against that. So there will be a 20% IHT charge, but there is a £1 million nil rate band. In the original draft of that legislation, that was not transferable between spouses, like the other nil rate bands, but they are going to correct that. So the surviving spouse will get a £2 million if it isn't used on the first death. Unfortunately, that was the only change they have made to those rules. The quite public protests by farmers have not really been listened to, and the behind-the-scenes protests of business owners haven't been either. So we have got a window of opportunity before next April to do some planning around that, and if you haven't started yet, now's probably a really good time to look at it. Also announced last year, the changes on IHT on pension schemes, which is going to start in April 2027. The personal representatives of an estate are responsible for paying the inheritance tax on an estate. So they've been given a few extra powers to direct the pension administrators to not pay out benefits for up to 15 months after the death, and to instruct them to pay the IHT charge that arises on those pension schemes. Really, that's just a bit of administration to make sure that the personal representatives have good time to work out how much IHT is due and to make sure the pension scheme doesn't pay it all out before it gets paid. So again, something which is coming in April 27 and should probably start thinking about any planning around that sooner rather than later. Other bits and pieces around IHT anti-avoidance, bringing in that charge on agricultural property in April next year. They need to protect it from people who have set up offshore structures to hold that kind of property. And so much like UK residential property, offshore structures will be effectively transparent for IHT purposes. And so the trustees or the individuals that hold those structures will be taxed to IHT from next April. Again, there are a couple of smaller points around offshore trusts where you can play with the location of assets to avoid certain charges, which they're going to restrict to make sure that when settlors of excluded property trusts leave the UK again, those assets are caught by the exit charge that happens at that point in time. And finally, they are bringing in restrictions on gifts that qualify for inheritance tax relief to just be to UK clubs and charities. I think there was a lot of concern that charitable gifts were being made to non-UK clubs and charities, which maybe weren't entirely kosher charities at the end of the day. And finally on this, when a person comes to the UK and becomes a long-term resident, their trusts follow them and become subject to the UK IHT charges on trusts. Some people are lucky enough to have trusts that are worth more than £85 million. And so their 10-year charge is £5 million at that point or more. And to try and just stave the amount of people I think that are probably leaving the UK, they're going to cap those 10-year charges to £5 million. I think it will affect a very few number of people, but they're obviously slightly concerned about the wealth leaving the UK. Moving on to the next slide, which I've done twice. Let's go back up. Okay, so moving on to ISAs. This was pretty well touted before the budget, that the government were looking to restrict how much people could put into a cash ISA. So they will be restricting that to 12,000. They want everybody to invest instead into stocks and shares, want to increase investment into the UK, and secondly, because they think that will give people a better return. Fundamentally, though, a stocks and shares ISA, I'm reliably informed you can hold investments which are close to cash from a risk and a return basis within there under current rules. So if you're concerned about having a stocks and shares ISA, but you still want to put your full 20,000 in, have a word with your financial advisor. And if you haven't got one, we can help out with that. For the rest of it, again, with the general trend of freezing limits, the ISA limits are again frozen with everything else to April 2031. 20,000 for ISAs, 4,000 for lifetime ISAs, which are for younger people to save up to buy properties, or if they don't use it to buy a property, it's an extra bit of pension that they can take out after they're 60. And 9,000 for junior ISAs and child trust funds. The one thing they have done is obviously as you get closer to retirement, they recognise that people do want to de-risk a little bit. So savers over the age of 65 will still be able to put 20,000 into a cash ISA each year rather than having any risk in the stock market. And again, the government are going to consult in 2026 on the lifetime ISA because it's fairly restrictive on what you can do with it. And the penalties if you cash it in outside the rules are punitive. So they've people have asked them to look at the value of the property you can buy with your lifetime ISA, because at the moment that's limited at 450, and they're hoping that properties will be increased on that, and indeed that this penalty that they charge will be something a bit more akin to the extra cash that the government put in to match. And finally, the Help to Save scheme. So this is a scheme for people who are on universal credit, and the government tops up their savings by 50p for every pound that they save. And they're going to make that scheme permanent rather than temporary as it was, and expand it to more people so that the government can help them save even more for the future.
Just before you move on, David, I'm going to just track back to the earlier. I'm going to call it the mention tax because its real name is a bit of a mouthful. There's a couple of questions around the valuation. So, how will the 2026 valuations on which the charge rebase be carried out? Well, look, anybody feeling particularly entrepreneurial on the attendees start a valuations business today, and one that perhaps focuses on appealing the valuations. What's been released in the press release is the valuations we've done on a risk scored basis. I mean, if you're clearly between 2 and 2.5 million, you'll just be slapped into that bracket, and the time will be spent on the properties that are at the fringe. But for the level of tax being collected, no one's going to spend a lot of time on this. And I think one of the other questions about will there be drive-by valuations in 1991? Well, since 1991, there's a hell of a lot more data available digitally, but we're not going to have a chat with a clipboard standing outside your house working out what it's worth. It's going to be based on other data, and there will be an awful lot of appeals. Because to an individual paying 7.5 grand is a lot of money, to the government it's not a lot, and there's going to be very scarce resource allocated to dealing with those appeals. I think this is a real chaotic tax, and whether it will ever see the light of day long term, who knows? But it's going to be a very, very expensive tax for the revenue to collect. On the ISA question, David, somebody asked a question about what would stop somebody putting 8 grand into a stocks and shares ISA and then later transferring it into a cash ISA. I would imagine the transfer will be limited to the 12 grand limit in the year, but we haven't seen the detail yet. Have you come across that as a suggestion?
No, not at all. And there are already restrictions on you transferring from a stocks and shares to a cash ISA, I think. So you have to be slightly careful anyway.
Yeah, I mean, the previous ISA suggestion was made, I think, probably former government, which was the British ISA, where ISAs had to invest in UK stocks and shares. Once the experts who actually knew about the ISA regime looked into it, it was scrapped because it's a difficult regime to play with. So again, we'll see whether this actually finds its way into reality. But it's certainly the Chancellor's concern that people investing in cash aren't getting the investment returns they deserve. Good for her to be concerned for us.
Okay, so wait for the screen to move over. Investment reliefs. So, as many people may know, if you invest into EIS, you get income tax relief. You can invest up to £1 million a year and get 30% income tax relief, and roll over any capital gains into that investment as well. What they have done now is increase the size of companies that can receive that investment. as you can see there, so that the gross assets can be a bit higher now than they were previously. And again, the amount that a company can raise each year is also being increased. Clearly, lots of people invest into these things to reduce their income tax and capital gains tax each year. These are all generally startup companies and therefore a bit more risky, which is why you get the tax relief. But there's obviously more scope in the market for people to invest, so they're helping slightly larger companies get more investment too out of this. The one downside to it is the income tax rate relief for VCTs, which are essentially funds that raise cash to invest in similar types of companies, will reduce from 30% down to 20% each year. So probably just to reflect that they're slightly safer than investing into the companies directly. And I think that is probably it from me. So handing over to Tim, I guess, on the employment tax side.
Right, I shall try and multitask with questions and talking at the same time, but if my colleagues to keep an eye on the questions. Right, a few changes in employment tax. So salary sacrifice changes. Salary sacrifice is an incredibly popular way of paying for certain things, namely pension contributions, electric cars, cycle to work schemes. This change is only focusing on pension contributions. There's no change to people who've got, for example, electric cars through a salary sacrifice scheme. So the salary sacrifice scheme is now for pensions and now being limited to a maximum sacrifice of £2,000 per annum. That caters for the vast majority of the population. If you think most people are salary sacrificing their employee contribution, which is 5% of earnings at the basic level. A 2% cap is catering for people up to £40,000 of £40,000 of earnings. So that does actually allow for quite a lot of the working population. However, for those who are contributing more, they're going to find if they carry on contributing through salary sacrifice from April 2029, they will find that there's additional national insurance employees and employers on the amount contributed. So a couple of examples there. Salary of 50,000, 5% employee contribution, the basic auto enrolment pension contribution made by the employee, which they choose to make under salary sacrifice. £500 is therefore above the £2,000 limit, which is now subject to national insurance. £40 on the employee, 8%, and the employer is paying 15%. On a salary of £100,000, the 5% employee contribution, £3,000 is above the £2,000 limit. You'll see the effect on the employees' NI. The net salary is not a lot because the national insurance at that level is only being paid at 2%, but there's a bigger employer's NI saving or employer's NI liability for the employer. Many employers were putting that saving into the employees' pension scheme. So what this equates to is less going into pensions. So it's going to erode some retirement savings. So there's a knock-on effect, possibly many later years down the line when pension pots are going to be smaller than they would otherwise be. There's also a lot less incentive for employers to put in place salary sacrifice schemes. There's a bit of hassle to doing them, so they may choose not to. If that leaves employees just making employee contributions as normal, the tax relief for a relief at source scheme has to be claimed on a tax return. And at last estimate, about 1.5 billion of tax relief has been not claimed that way because employees who don't file a tax return just never get round to claiming the relief. So this is, again, fiddling around with ISAs and pensions. It's a fiddly regime anyway. I think this is it's going to be a very unpopular change. However, at the top end, I think it peaks in government estimates. It's going to raise 4.8 billion in a single year. So even though these numbers on the screen look very small, there are an awful lot of employees who are affected. Just have a quick look to see if the questions come in relevant to this topic. How is pension NI going to affect company pension contributions to directors of SMEs? Well, directors are treated just like anybody else. If the company's making the contribution, that's outside of this. It's only where the employee is sacrificing their salary and choosing for that to become an employer contribution instead. Now, the quick thinking amongst you might be, well, we'll just reduce all of our employees' salary by a couple of £1,000 and increase the employer pension cost by £2,000 or £3,000, whatever it needs to be, and that neatly sidesteps these rules. I'm afraid it doesn't. We haven't yet seen the anti-avoidance, but what's called the optional remuneration rules are going to apply to this. So if you do change the salary levels, reduce the salary levels in agreement with your employees to increase the employer contribution, that's not going to work. So we're waiting on more detail on precisely how that's going to be policed, because I suspect the answer is it's going to be very difficult. But the government are expecting to raise a lot of money through this measure. They're going to be fairly intolerant of people trying to sidestep them. Right, salary sacrifices, we're done. So employee ownership trust. Well, look, this was an unexpected one. My clients every budget say, are there going to be any changes to employee ownership trusts? To which my normal answer is, they've already consulted fairly heavily on employee ownership trusts. They're generally happy with the regime. We had some tightening up of the rules a year or two ago. It felt like a fairly stable regime. What we now found with no training, I certainly didn't get any hint of this from any of the journalists or other lobbyists that I speak to, is that we've got a halving of the relief. So employee ownership trust, this is where the owners of a business can sell their company to a trust for the benefit of their employees. The sale to the trust is entirely tax-free. And whilst this is great for improving employee engagement and hopefully increasing productivity amongst the employees, it also gives the owners of the business the ability to extract the entire value tax-free. Now, from yesterday, this was an immediate on-budget day change, which I think is overly harsh, given this was not tax avoidance. This was a government scheme, so there wasn't a loophole to be blocked here. This was just how it used to work. But from yesterday, the relief is now at 50%. So to choose an example, if somebody's got a company worth £20 million, they were selling it to an EOT, well, there was a very small amount of stamp duty paid, but otherwise no other taxes, and they could withdraw that £20 million from the company over a number of years without any further tax charge. From yesterday, that same transaction will cost an immediate tax charge of £2.4 million, because there's no availability to claim business asset disposal relief or investors relief, so it's at the top rate of capital gains tax. That is going to make EOTs very unattractive to certain people who can't cash flow that immediately. So they may wish to do an EOT, they may wish to pass their business over to employees, but if the upfront capital gains tax charge can't be funded because the company isn't generating cash that can be distributed at that rate, an EOT option is then closed for them. I think this is a very, very disappointing move by government. The employee ownership community is a fairly powerful lobby group. There are some fairly well-established companies in there, so I would imagine they will already be writing to the Chancellor to say this is a bad move. But it raises £1 billion a year, they think. It may be just what the new normal looks like. Alongside EOTs, we often do work with share options. So the Enterprise Management Incentive Scheme, the rule with share options, or at least mine, is if you want to do a share option and you can do an EMI, you should do an EMI. It's a very, very generous, well understood share option scheme. It was previously limited to smaller businesses, although they weren't really that small. Gross assets of up to 30 million, up to 250 employees. All these limits, as you can see on the screen, have been increased. So the gross assets from 30 to 120 million, the employee level from 250 up to 500 employees. So it's been made, the scheme is now open to larger companies. The scheme can run for longer. It was previously an option could only last for 10 years. It can now last for 15 years, including all existing options. However, the bit of the scheme that I was really hoping would be changed is the per employee allowance. So an employee can have up to £250,000 of today value under option. If they go above that, they don't hold an EMI option. With a company that's got gross assets of 120 million, the £250,000 per employee limit feels a bit low. So that's the one I'd really like to have seen increased, which the government have absolutely not commented on. I think they've, this is a generous scheme. They don't want to make it more generous. They just want to make it open to more businesses. Now, a lot of questions have come in. So does this impact EOTs already been formed? No, this is only for sales of EOTs from the 26th of November. I'm sure there are some people on this call who are midway through an EOT process and they've had the rug pulled out from under them. If I were in government, I would have made this a 6th of April next year measure. So those people who are halfway through an EOT process have a chance to finish it off before the new tax charge bit. Same question again about will it apply? What I'll do as I move on, the other speakers, I'll answer all the EOT questions by typing. If I think there are good ones which draw out interesting points, we'll come back to it so that I don't try and multitask too much and embarrass myself. I think the next point on employment taxes I just wanted to cover was the national living wage and national minimum wage. This is more or less, in line with what we see every budget, an upticking of the national living wage, national minimum wage. I spoke to Peter Davies, who runs our hospitality sector, and said, well, of course, this is another blow to the hospitality sector. His response was it was towards the bottom end of what the sector was expecting. So the 4.1% for national living wage was towards the lower end. So actually, although it is a blow, it's already difficult in that sector with the previous increases to living wage and minimum wage. It wasn't quite as bad as we thought it would be. The bumper increase of 8.5% for 18 to 20-year-olds is a blow, and it's going to make for businesses that are employing at that level, who are employing at around the national minimum wage, national living wage, less likely to employ 18 to 20-year-olds. So it's only a bit more to have somebody who's a bit more experienced. So that's a worrying trend for youth unemployment. It's all to do with a shift of scrapping the 18 to 20-year-old bracket, and there only being one bracket. So we'll carry on seeing bumper rises at that level each year until we have only a single bracket and we don't distinguish between 18 to 20-year-olds or the older categories. But yeah, a bit of a blow for those sectors who are reliant on the lower cost workers. I think that brings us to corporate and business tax. So I'm going to head back to the questions and answer those we haven't answered. Otherwise, I'm going to hand over to Nick, who's been waiting patiently to tell us about corporate and business taxes.
Thanks, Tim. Well, yeah, hi everyone. We've just got a couple of minutes left, but that's probably all we need because there wasn't very much trailed on corporate taxation in the months leading up to the budget, and that's exactly what happened yesterday. That there was actually very little of anything material that came through on corporate taxation at all. So I did just want to remind everyone of the things that haven't changed in terms of rates. As Tim mentioned at the beginning, there was commitment from the government not to increase the rate, that the 25% that's been in place, and they've committed to keep it through to the rest of this Parliament for profits over 250, and for profits under 50,000 the tax rate stays at 19%, and then there's a sliding scale if your profits are between 50 and 250,000. So those rates are all the same. They have announced increase in late filing penalties for those of you who submit your tax returns late, this is corporate tax returns, the late filing penalty will increase or double from £100 to £200, and then further late filing penalties as well. The rates had stayed the same since 1998, so what's that, 27 years ago. So they've brought that in line with inflation, that late filing penalties are now doubling. Capital allowances. This was where there was the only real change of any substance in the corporate taxation world. It's worth reiterating again what has not changed. So people might be familiar with the annual investment allowance, which is available to everyone, companies, sole traders, partnerships, and that's fixed now at £1 million. So if you're spending less than that, the likelihood is that you're not affected by any changes yesterday. The full expensing regime, which is available to corporates as well, or corporate members of partnerships, is not changing either, which is 100% first-year relief on new and unused plant machinery. So just reiterating, that does only apply to corporates. So what was announced yesterday was something, I suppose, that will mainly affect sole traders or individual members of partnerships, so unincorporated businesses, basically, which have been used to writing down allowances on fixed assets of 18% a year. There'll be a new 40% first-year allowance for that type of expenditure, but then going forward on a reducing balance basis, it'll only be 14%, not 18%. I got my calculator out and worked out that after about 7 years, the two things converge, whether you'd had 18% reducing balance or 40% and then 14%, you get to the same point after about 7 years. So after that, you'll have a much slower rate, and that's why the government thinks they'll get, in a few years to come, they'll get about £1 billion a year additional revenue as a result of these changes to capital allowances and the slowdown of the rates of pools from 18 to 14%. So that was the announcement yesterday on capital allowances. There also been some lobbying from the sector, the leasing sector, those who acquire big things like ships or trucks and then lease them out to other people. Full expensing is not available on those, but there'd been a consultation to try and get it. They haven't got it. They've just got the 40% first year allowance that I mentioned. So not a big change for that sector either, really. The remaining corporate tax changes, much of them sort of international in nature, were very administrative, technical. To Pillar 2, which is the global minimum tax that some of you may have heard of, to make sure that multinationals are paying 15% in all the jurisdictions in which they operate. There's been some technical changes there. permanent establishment rules, diverted profits tax. The only thing I probably did want to mention is transfer pricing. There's an exemption from the transfer pricing rules for SMEs. That's those businesses where there are less than 250 employees and a turnover of less than 50 million euros. There'd been a wide-ranging expectation that the exemption from the transfer pricing rules for SMEs would be removed. There was no announcement on that yesterday, so that was probably the main thing, was what was not announced, which was, it seems that exemption will stay for SMEs. Some other tinkering round, corporate interest restriction rules, they apply when your finance charges are over 2 million. There's some administrative changes there. For R&D, those who claim R&D and are in the SME sector, again, they're piloting a scheme to give advance assurances on certain aspects of people's claims, and that will be from spring next year. And if that goes well, they'll then bring that in more formally to give advance assurance on people who are making R&D claims. There's been some technical amendments to creative sector reliefs as well, audio, visual, video games, and so on. And then there's been some changes to the charity taxation rules to strengthen some of the rules around tainted donations, approved investments, and non-charitable expenditure. I'll just finish off with a couple of indirect tax measures. Again, there was not very much trailed in the budget around this. I'll just pick up, I guess, on two of the higher revenue raising items. Vehicle excise duties. There's going to be a new mileage charge for electric cars and plug-in hybrid cars, 3p per mile and 1.5p per mile, depending on what type of car it is. That will be from April 2028. The expectation is that will bring in about £1 billion a year into the exchequer from these new charges. So it's by no means insignificant, the amount that they think they're going to be able to raise from duties on electric cars. I don't know whether that'll do to drive to get people to buy electric cars. And then finally, the tour operators margin scheme is a VAT relief scheme for certain operators in the touring industry. Various ride-hailing apps had been making use of this VAT relief, probably not in the spirit of the legislation. So the government is closing down loopholes around that, to the tune of raising around £700 million a year once they close that loophole. And those are the two main indirect tax measures that have been brought in yesterday in the budget. Thank you.
You're on mute.
So yeah, I just spotted I was on mute. It took me to the end of the webinar to work that out. So I think that was all. So there were a couple of questions, and it did track back to some of the things said earlier. So in the last few minutes, let's just cover these. So there's a question around the pension salary sacrifice, and I mentioned that if an employer chooses to reduce employee salaries and in exchange increase employer contributions, which looks like a salary sacrifice, but will be represented as not being one, so will be outside of these rules. There'll be anti-avoidance measures under the optional remuneration rules. From memory, I haven't had a chance to go back and look at the briefing again. I think the government paper says as long as that approach is applied consistently across the entire workforce, that wouldn't fall within the optional remuneration rule. So if as a business that is a strategic decision taken across the entire employee workforce that you'll hold pay rises and instead start to increase employer contributions into pensions, I think that stands a chance of being successful. If, on the other hand, and this actually tracks into a different question that's been answered, if for the board of directors who are all potentially able to make £60,000 of pension contribution a year, you single those out and reduce their salaries down in a year and make the pension contributions instead, I think that's far more likely to then fall within the optional remuneration rules. We've got until, I think, April 2029 for the government to try and figure all this out. But the optional remuneration rules have a very high degree of subjectivity in them, in my estimation. So I think those who choose to try to do clever things around pensions, there's always going to be some risk that on your next PAYE compliance visit, you're going to find that it hasn't worked. So we'll wait for further guidance. As always, take advice. We'll do our best to guide you through the rules. You can see anything, as I said earlier, pensions and ISAs, anything messing around with those regimes, they are so complex. They're quite difficult to actually get effective changes through. The fact, going back to what I said earlier, 4.8 billion to be raised in the peak year for the salary sacrifice change, the government will be committed to it. We've got a question around investment relief. Investment relief is a sort of a very minor relief, very rarely claimed for people who are investing in companies but have no other connection to them. So that's unchanged. It's a sort of poor cousin to business asset disposal relief. Somebody's asked, is it almost somebody doing our work for us? Have we produced a budget summary? Yes, it will be circulated with the slides from this webinar. You'll get that together with a feedback form, which will give us our full in-depth summary on every measure, and we'll keep that updated as more information is released. And then the final question, possibly from somebody who works in the financial planning industry, will we envisage insurance-based savings, so investment bonds will become more attractive to higher rate earners? I think so. I mean, Claire mentioned this in her slides, the increase of tax on savings income, dividends, and interest received, general savings income, should cause everybody to look at their portfolio, assess the impact on them, and just decide whether there is a different way of holding it. As a basic, you should, of course, be maximising out your ISA allowances each year, subject to the new rules on what you should or shouldn't invest in terms of cash and equities. When you move up the spectrum, you're looking at family investment companies, and as the person who asked the question, insurance bonds as well, which provide a tax-free wrapper to hold investments in. So the government always forecasts how much they're going to collect from this. They don't always anticipate the behavioural changes where people will just do different things to sidestep the new tax rates. And I think that's going to happen a lot. So, what the government have done is a bit of marketing for the financial planning industry rather than introduce a measure that's going to collect very much tax. I think that's probably all the questions answered, but we've got, and I think what we never want to do in these webinars is keep you just as we revert back to the sort of the intricacies in detail and some of the more complex measures. So I hope everybody's found that useful. I'd like to, of course, thank my fellow speakers, Claire, David, and Nick, who pulled an all-nighter to pull all that together, along with colleagues behind the scenes. So thank you for pushing that together so quickly. And we hope, as I said in my opening comments, we have a return to growth. Now we've got a bit more stability, all the uncertainty's gone, and we can get on with the day jobs again. So I feel positive but bruised. Anyway, I'll leave that as a parting comment. Thank you very much, everybody.